If you have a day job and a boss who constantly watches you, then trading the Forex market can be a real challenge. But you still want to trade, so you sneak into the toilet to check your trades, only to realize that you didn't exit in time, or that you missed the perfect trade setup. You were spot on about where price may rebound, except, well, you're not on that trade. If that's you, then I'd like you to test out this high probability set and forget Forex trading strategy that I'm going to show you shortly. So what I mean by set and forget is setting in a limit order, letting price come into your limit order level, and either hitting your stop loss or take profit target. You either make money or you lose money. Depending on how you see it, this can be a blessing or a curse because, well, you know, trade management can be challenging. Sometimes you slap yourself on the forehead because you got out too early. And other times, you were greedy and end up giving back all your unrealized gains. So this strategy will take out the element of trade management and perfectly fit you if you have a day job. No more worrying about missing the trade setup or going into a meeting wondering if you end up exiting too late. Just set in your limit order and wait for the results. Sounds good? If that sounds good, then please do me a small favor and hit that thumbs up button. It helps support the channel and I appreciate that. If you wish to participate in our giveaway worth $37, then look for an emoji somewhere in this video. You can also find the full instructions in a pinned comment down below as well. So let's dive straight into the trading strategy. For this trading strategy, we will borrow a concept that I learned from trading supply and demand. In my earlier trading days, I was mentored by a trader who came up with a rule-based supply and demand trading strategy. But anyway, you don't need to know that. What you need to know is the concept of a rally-based rally and drop-based drop. And here's an example of how both of them look like. The rally-based rally and drop-based drop are just opposites of each other. The former is used in a bullish scenario and the latter is used in a bearish scenario. As you can see, it consists of a big range candle or what some call the extended range candle, followed by a base and then another big range candle. Now the base is a small tight body candle which may be like a doji or even a full body candle, so long as it's small. Just be careful not to confuse the base candle with a shooting star pattern or hangman pattern. A shooting star or hangman pattern is a reversal pattern. A doji pattern, on the other hand, represents indecision, and that's what we want. After seeing a doji, we want the next candle to be extended range candles. When we see all elements present, that's a rally-based rally. The opposite is true for a drop-based drop. So let me show you a couple of examples so that it is clearer. Right here, we see that price has been dropping and we get a pause in the market, and that's a doji. Price eventually breaks down and that's our drop-based drop. So quickly, let me do a quick explanation of what a rally-based rally or drop-based drop means. When you see these patterns, it means that there are many unfulfilled orders at the base. Before price could consolidate and accumulate, what supply was quickly scooped up, resulting in the subsequent rally or drop. The base is where there are many unfulfilled orders, and when price retraces to it, it's an excellent place to look for a trade. So hopefully you now understand the patterns that we are looking for. So let me show you how to apply these patterns and look for the high probability setups. This portion is very important, so I want you to pay close attention. Do not start looking for rally-based rally or drop-based drop and start trading them just yet. Please take the time to understand them. We have to use these patterns in the right market context with the ascending or descending triangle chart pattern. I'm going to assume that you know what an ascending or descending triangle pattern looks like. But if you don't, then I will leave a link to one of my previous videos. In that video, I will show you step by step how to identify them, how to draw them, and how to trade them. That video will show up at the top right corner of this video and at the end screen of this video. So let me show you what I mean by using these patterns in the right market context with the ascending or descending triangle chart pattern. Right here, this is an ascending triangle, and at the top of the ascending triangle, make a guess. What do we see? Well, if you have been paying attention to how a rally-based rally looks like, then that's what you should see. If you were not able to spot it, no worries, give yourself some time and rewatch the earlier portion if you need to. Basically, what you want to see is a rally-based rally that happens at the top of the ascending triangle. This tells us that there are a lot of unfulfilled orders at the top of the ascending triangle. Now, because the top of the ascending triangle was formerly a resistance, we expect this level to hold as support. By combining it this way, we are essentially trading off a key level that has lots of unfulfilled orders. Often when it comes to rally-based rally, the price will spike down to the level and rebound strongly. This is why it's super important that we use a limit order. If you wait for price to show a bullish candlestick pattern, it might already be too late. And hey, besides, didn't I start off this video addressing the challenges of trading when you have a day job? So let's not do that. We already have a strong level and unfulfilled orders at that level, and that should be enough. To enter this trade, you want to place your limit order just slightly above the high of the doji candle. This ensures that you get filled for the trade. Many supply and demand trading strategies teach you how to draw the zone using the candle's body. And while you can do that, you might risk not getting filled just because you were unwilling to set in a couple of pips higher. So to keep them simple, just set your buy limit a couple of pips above the doji's high. As for your stop loss, you want to set it at a couple of pips below the doji's low with a buffer. Because this is a set and forget trading strategy, you should input a take profit. I recommend keeping it simple and using a fixed risk to reward of 1:3 as take profit. If your stop loss is say 30 pips, then your take profit will be 90 pips. This way, you don't have to be right all the time. You can be right just 25% of the time and still break even. Set in your take profit and let price do its thing. It either hits the take profit or you get stop out. It's the set and forget style of trading. Now, of course, if you wish, you can always tweak the strategy and start managing the trade manually. But if you have a boss who is constantly breathing down your neck and piling heaps of work on you, that's not something I recommend. So let me run you through a drop-based drop setup before ending off this video. In a bullish setup, it's an ascending triangle. For a bearish setup, we need a descending triangle. Over here, we have a descending triangle. And if you were to look closely at the horizontal support, you should be able to see that there is a drop-based drop. This is the setup, and when you see this happening, we can go ahead to set in a sell limit at the low of the doji candle. Your stop loss goes above the high of the doji, and I will box it out like this and refer to this as the zone. In some cases, we might not get the retracement and end up missing the trade because we are using a limit order, not a market order. But well, that's all part and parcel of trading. But in this example, price does retrace back to the zone and there's a trade. You can see that price rejects the zone nicely and starts falling afterwards. So let me sum up this video. For this high probability set and forget trading strategy, you need to understand the two kinds of supply and demand patterns. They are the rally-based rally and the drop-based drop. And because they are just the opposites of each other, in a sense, you only need to recognize one type of pattern. To trade them, we combine these patterns with an ascending or descending triangle and look for them to occur at the horizontal level. Once we see that, we can set in our limit order, stop loss and take profit. Your stop loss goes below the doji's low if you are buying and above the doji's high if you are selling. As for your take profit, I recommend sticking to a fixed take profit target of 1:3, but feel free to tweak it accordingly. That's it for this video. I hope you learned something new. Make sure to subscribe if you have not. As promised, I will leave a link to the video that teaches you how to identify ascending or descending triangles. If you are new to trading, that video is crucial because what you have just learned will not work if you do not understand how to identify an ascending or descending triangle. Thanks for watching. I'll catch you in the next one.